want to get the shareholders' take on the big banks. Macrae Sykes is portfolio manager at Gabelli Funds. His fund owns shares of Citigroup, Goldman Sachs, and Bank of America. Macrae, it's good to talk to you today. Is there a theme that you're seeing with the banks that you particularly like, that's particularly optimistic for you as an investor?
Well, I think overall, for the banking sector, we're seeing a troughing of NII and acceleration towards earnings gains for next year. And so I think that's a good setup for the whole industry. Obviously, we have a couple of idiosyncratic components to that. Citigroup, JP Morgan, which is going to see some headwinds, which they mentioned on Friday. So we have a little bit of movement between the different entities. But in general, the industry is moving towards a more beneficial cycle, Fed easing. And Bank of America is one example of that today in terms of iterating kind of positive NII as we track through 25.
Why is Citi the outlier today?
Well, I think Citi had a couple of idiosyncratic components to it. They talked about that expense headwind going forward. They delayed their IPO of the Mexican operation, so I think that was a little bit of a disappointment. And then they have this regulatory overhang, which there was a number of questions on the call about that in terms of, what's the ultimate cost and what is, potential penalties, et cetera. So I think that uncertainty is going to be weighing on those shares for the time being.
Leslie, how much of a factor is it that they have set aside more money to reserve against potential losses?
Well, it caused about a 9% hit to net income, so it was sizable. A lot of that has to do with credit cards, both the fact that people are using more credit cards and also that they have to set aside more allowances for those credit cards. And they were seeing some lower FICO band customers struggling a little bit more in this higher interest rate environment. Although the dynamic changed toward the end of the quarter, it's still impacting people. Credit card rates do take some time to really come down as the Fed cuts.
They never come down all that much.
They don't.
To be honest with you.
When you look at them, I think the average right now is about 21% or 22%. It's very high.
Maybe they'll come all the way down to 19 or something like that.
One could be so lucky.
Yeah. So, Macrae, as you look forward to an interest rate regime where rates are likely to decline, whether by another half point this year and then how much next year, who knows, what is that going to do to these big banks?
Well, I think you really have to go and dissect it, balance sheet by balance sheet. Today on the call with Bank of America, they talked about, some of the HCM that's rolling off, 10 to 20 billion a quarter. That is on there, pretty low rates, and so that will be reinvested. And even as the Fed brings down rates, the forward expectations are that they will still be able to reinvest that with an improvement in NIM, which will affect NII, obviously. And then also you have growing deposits. So this is the fifth quarter that they've had added deposits. We hope to get some more loan growth going forward, too. So that'll also affect the outlook for NII. And so you had a similar situation with Wells Fargo on Friday and that outlook. But on the contrary, JP Morgan is a little more asset sensitive. And to the extent that loans start coming down in terms of that impact, they're going to see some headwinds. And so they expect to inflect, potentially at the end of 25, maybe before then. But, a little behind in terms of the other banks. But, they are really earning much more than the other banks. So, a NIM closer to 3 with Bank of America's NIM closer to 2.